from the US to Asia and Europe. It was a bloodbath on markets across the world after the clearest sign yet of a coming recession.
Based on the numbers, the economy is clearly tumbling. There is a significant fear of a recession, not just for the world economy, but also in the US.
Global losses tracked the Dow Jones Industrial Average, which fell more than 800 points on Wednesday for its biggest drop this year. Investors pointed to an inversion of the yield curve for US government bonds, a phenomenon that's preceded every recession since 1955. The yield curve usually slopes up because fund managers want more money for longer-term loans. It flips when investors fear a slowdown and rush to safe assets like US Treasuries. This happened on Wednesday, driving the price of 10-year US government bonds below their 2-year counterparts. The same took place in 2006, about a year before the start of the subprime mortgage crisis that led to the global recession.
I think the bond market's making a very clear statement right now, which is trade wars are horrible for the global economy, and Trump's America First policies are maybe good in some ways for America on the short term, but really bad for America and the global economy on the long term.
Data out of the US released on Thursday was mixed. Retail sales surged in July, but jobless claims rose more than expected, and manufacturing productivity was down in the second quarter. Other major economies are also showing signs of a slowdown. Germany's export-reliant economy shrank in the second quarter, while China's industrial output grew at its slowest pace in 17 years last month.
Given the complicated and grave external environment and the mounting downward pressure on the economy at home, the foundation for the sustainable and healthy development of the economy still needs to be consolidated.
Last year, the US imported more than $500 billion worth of goods from China. By December, nearly all of that will be subject to import taxes. Beijing has promised to retaliate, further escalating a trade war that analysts say could have lasting global consequences. Paolo Montecillo, TRT World.
Let's get more on this now with David Levine in Greenwich, Connecticut. He is the founder of the investment firm Odin River. Welcome back to Money Talks, David. We heard there an explanation of the yield curve inversion when returns on shorter-term bonds are basically higher than the returns offered on longer-term debt. It's a phenomenon that, as we know, has happened before every recession over the last 50 years. How worried are you about the current yield inversion that we're seeing?
Well, it's great to be back. Unfortunately, the yield inversion is only one of many data points that are concerning in the global economy. And I think it's important to point out that some of the macroeconomic indicators outside of the United States, specifically China, Germany, as was mentioned, is actually in a recession already, are concerning. So this is really a global phenomenon. Now, today, Janet Yellen said that this might be the first time in history that the yield curve does not indicate a recession. Meaning since the 1950s. So it is possible that the yield curve is saying something different today than it has since 1950, at least according to Janet Yellen. But if it was the only negative indicator, I think maybe she might have some room to be correct about what she's saying. But there's many indicators that are actually pointing to a negative global slowdown.
Interesting. As we know, the curve inversion that we're currently seeing is being driven by investors flocking to the relative safety of government bonds as they, I guess, look on the stock market less favorably. What do you think is driving investors to ditch stocks in favor of government bonds?
It's important to put this again in a global context because, markets are global. And one of the things that's happened is that there are now $16 trillion of negatively yielding, primarily government debt around the world today, outside of the United States. And so what's happening is actually around the globe, bond yields have fallen to extraordinarily record low levels. So some of what's happening is that folks are not only scrambling to find safety in the context of a slowing global economy and therefore shifting out of equities, they're also trying to avoid having to buy negatively yielding debt outside the United States. And this might be what Yellen's talking about, in that there are these other factors, meaning negatively yielding debt, that's driving investors into the quote unquote refuge of US Treasuries. But there are many factors that are causing this phenomena, in addition to, as you mentioned, the concerns about the equity markets, which of course are tied to the global economy, not just the US economy. Because remember, the S&P 500, the Dow, these companies are no longer only US oriented companies. Much of their growth, much of their earnings is tied to places like China. And so when the global economy slows down, it's negative for US equity markets.
Well, let's talk about the situation with China, because many analysts are citing the ongoing US-China trade war as one of the main factors that's driving down global growth. Do you think, given that Donald Trump is up for re-election next year, might these latest figures, the latest yield curve inversion, perhaps spur him to seek an end to this dispute with China?
Unfortunately, I think that people overstate the importance of the trade war with regard to economic fundamentals. When you look at companies' earnings, when you look at companies, say, from the semiconductor industry to the automotive industry, when they talk about what's impacting their businesses, trade is a small part of it. You know that in July, China had one of its worst months in history in auto sales. And when you look at the industrial output of China, which, as was mentioned, is at a 17-year low, not all of that is tied to trade. Unfortunately, the Chinese economy just had their slowest quarter in something like 20 years of GDP growth. And so while I think it's possible, to your point, that maybe the president will try to do something with regard to trade with China, I think he just the other day delayed the tariffs from September to December, but the markets have shrugged that off. And it seems to me that the fundamentals, meaning the actual slowdown in the Chinese economy, might be more important than trade. And so, yes, maybe there'll be a settlement. Maybe that would be an attempt to help, spur the markets. And I think that's actually what happened 2 days ago. But I don't know that that will be enough, because the economy is slowing down more broadly, especially, in industrial sectors.
Okay, David Levine, we'll have to leave it there, but thank you for your analysis as always.